scrolling through your Twitter, I think you were trying to highlight the importance of the yen carry trade. You highlighted a paragraph from an IMF article, and the abstract reads, the financial press at the time, I think you were talking about the 2008 credit crisis, referred to a collective margin call on the United States in which foreign creditors sought to reduce their exposure to the deteriorating creditworthiness of U.S. borrowers. This paper argues that the carry trade should instead be viewed in the broader context of global credit conditions. What does all this mean?
It means we're all. I don't know how else to say it. It's like no, but really, it's. I'm making light of it because I think it's funny, legitimately, and I think you have to have humor in the face of what could be a crisis that nobody can really fully control, just try to manage through, right?
Michael Gayed joins us today on the David Lynn Report, and we are talking about a major credit event that may shock the entire world, and it's going to come from a place that you may not have thought about yet. Michael is the portfolio manager of Tidal Financial Group. Welcome back, Michael. Always good to see you.
I got to say, David, you are one of the hardest working men in this business. And I got to give you a lot of credit because you have been crushing it on YouTube. And if those that are watching this YouTube channel are not subscribed to David, you are out of your minds.
Likewise, Michael, I'm just trying to get up to your level. Please subscribe to Michael's Twitter, his very fast-growing Twitter feed of 700,000 people. I don't know how you did it. We'll talk about that offline. And maybe give me some pointers to grow my Twitter feed.
I've been told it's all bots and unfollowing by people that have no idea what the hell they're talking about.
You've been warning about a credit event for quite some time. I want to just clarify exactly what you mean first. What part of the credit market is going to see the biggest moves and is going to have a problem? So what do you mean by credit event? Let's start with that definition, and then we'll talk about Japan.
Okay, so credit event is just another way of saying massive VIX spike, which is another way of saying potentially the end of the bear market, which I know sounds crazy, that I still think we are in, right? Because that's how bear markets tend to end, with a bang, not with what we saw last year. Okay, so let's reset, because I think there's a lot of misconceptions around the way I look at markets. And by the way, the interaction of the way I look at markets and my rules-based funds, which have nothing to do with me because they run the exact same way if I die tomorrow. Okay, so I loudly yelled in October of last year, conditions favored a melt up. The thesis back then was yields were rising so fast that you couldn't bet on that continuing. So you might as well bet on stocks. And I was pretty much right on that. December, I interrupted the melt-up argument and said, I think we're at the risk of an imminent crash. You didn't have a crash in December, but you had the fifth worst December in history going back to 1920s. Then after the first week of January, I said to you, as you interviewed me back then, it's a pre-election year. Pre-election years are historically among the strongest. It's a melt-up environment, but that there's a credit event out there, right? And I said that because people seemingly have lost their damn minds and forgot that interest rates act with a lag. We went through the fastest rate hike cycle in history. Interest rates don't impact the economy right away. They impact the economy with a delay, and not just the domestic economy, but global economies. Now, in April, I said third week of April, I believed a correction would start. Stock market didn't correct, although 7 out of 10 sectors went down heavily. AI mania took over. Narrative followed price. NVIDIA went insane. And apparently so did I, talking about NVIDIA on Twitter. And I've been, and by the way, my own strategy is turned risk on, even though I loudly said, be very careful. This is not healthy, right? I put a whole tweet that's pinned where I said, now I think we're actually pretty close to a credit event. Okay. Now, credit event means spreads widening. It means default risk getting repriced. It means fear getting refreshed into the market. It's not one of those things where I'm trying to be a perma bear. But there's all kinds of evidence that shows that nobody's prepared for what could be to come. And if Japan ends up being the catalyst, there could be some really nasty margin call unwinds that take place.
I need to back up for a minute. We're still in a bear market. Can you explain that?
Yes. Everyone loves to seemingly attack me on that, especially with their squiggles, as I say. First of all,
what are the squiggles?
The squiggles the squiggles. Yeah, I know. I always joke about it. The squiggles are those people that just show random lines on a chart as if it's something you can bet that has any predictive power. Okay. Now, I'm a big fan of empirical research. You've got to see if what you're saying has any predictive power. Otherwise, it's all nonsense. It's all imaginary. And I see a lot of that on the Twitter side, especially, or now X, whatever you want to call it. But hold on. So on the bear market, let's define bear market and bull market. Bull market, bear market has nothing to do with the percentages. Zero. You only know if you're in a bull market with hindsight if and after you've taken out the prior inflation adjusted high. the inflation adjusted high. So if the S&P breaks the highs of last, from 2021, okay, that's not after inflation. That's in nominal terms. You're still technically in the drawdown. If you overtake that level after inflation, then yes, with hindsight, you could say, you know what, it was a bull market. The October low was it, right? So it's more a question of sort of framework. By the way, you can't do anything with that information, right? That's just about perspective, right? I believe that we're still in a bear market because, again, nobody knows what the hell the fastest interest rate hike cycle in history is going to do to us. Just because AI mania ran wild doesn't mean that the cost of capital is irrelevant at the speed with which it rose. And by the way, that now is exactly what I think Japan has to wrestle with.
Well, I'm going to come back to that when we'll finish off on your market outlook, and I'm going to drill a little bit deeper. So yeah, bond yields. Looking at the ICE BFA U.S. High Yield Option Adjusted Index, peaked in 2008, 2009 for obvious reasons. Spiked again in 2020. Spikes whenever there actually is credit events and big periods of volatility. It's been trending down. So either the markets, like you said, aren't pricing in any sort of upcoming credit event, or they're just not ready for what's coming. Let's talk about this.
Right, and I'll send you the chart after this, but there is this really interesting chart that came from Bloomberg that looked at bankruptcy filings overlaid against credit spreads. Bankruptcy filings are factually increasing on the ground, while credit spreads have stayed very tight. Okay, in terms of public debt markets. So the question becomes, does that resolve? Right, do bankruptcy filings keep increasing and credit spreads stay tight, or would there be something that sparks suddenly a reevaluation of default risk in the high yield space, which again would be a credit event? I would bet it's more the latter. Okay, again, especially given sentiment and all these narratives that are simply following price. So you've got an interesting dynamic internally in the U.S. bond market from that perspective. By the way, against the yield curve, which is still screaming recession, it's like people only care about the yield curve when stocks are going down. Somehow everybody forgot about that, right? So because we're close to all-time highs. Now, this is why I keep going back to, look, it's a very interconnected world, obviously, right? So the carry trade is a big deal. Okay, the idea that money has borrowed from Japan, borrowed against the yen at the very low rates that Japan has had for decades, okay, and funded higher risk-seeking currencies going into, by the way, U.S. markets. I'd argue in particular into tech. If you look at the dollar yen against technology, the correlation is very, very high this year. So as the yen has fallen, technology AI stocks have done particularly well. Makes sense because you can borrow at basically nothing in Japan and then take a gamble, right, in the U.S. Now, it's funny, right? Markets exhibit characteristics of chaos theory, right? And in chaos theory, there's something known as the butterfly effect, right? A butterfly flapping its wings creates a hurricane. Japan is not a butterfly, it's a Mothra, okay, from the Godzilla movies. Okay, so my point is that the fact that nobody's even thinking about or considering the very real possibility that, by the way, the stock market with that reaction last Thursday told you is a big deal, just on the hints that Bank of Japan might surprise, tells me that nobody is prepared for what could be a tail event starting there. Now, I could be totally wrong, and David, you and I have spoken enough times. I've said many times I think housing's in a lot of trouble. I've said lumber is a big problem, and I still believe that, even though obviously I was wrong because housing hasn't fallen off a cliff yet. So I could be totally off on the thesis. But when it's raining, don't you want to slow down? Don't you want to maybe just reassess if everybody's driving past the speed limit with leverage, that maybe that's how crashes happen?
Yeah, driving past the speed limit. You're talking about the yen potentially going over the cliff, driving over the speed limit. I'm paraphrasing your very colorful tweet. The yen is absolutely screwed that you tweeted this morning. You've made very many different variations of this tweet over the last couple of days to weeks. And you also tweeted that the BOJ will either have to defend the yen again or risk severe inflation. No one is prepared. Do the Japanese right now, currently, and I mean this seriously, do they even understand the concept of inflation? When was the last time they had inflation?
Well, first of all, few understand this. By the way, not even frickin' Powell understands inflation because he actually said that. But your point is really important. You're talking about generations that don't know what inflation actually looks like and feels like if you're on the ground in Japan. Yeah. So it's like, the idea that the BOJ can just step in and raise rates and counter inflation, which a falling yen pushes higher against oil, by the way, which is also pushing higher. It's like they're going to have to, I think, panic the BOJ at some point. Now, if I'm right on that, compared with the speculative net short positioning in the yen is screwed, using your words, my more colorful way on Twitter, in terms of actually a short cover. rally, because I think the Bank of Japan is going to have to act and get much more aggressive. They're going to have to, just like we saw over the weekend, right? They suddenly stepped in after 2 days of just announcing the supposed loosening of the yield curve control policy, right? So this is my point. It's like markets have a funny way of punishing recency bias, right? And it almost has to come from something that is almost a little bit hard to understand, because people have natural home bias in thinking that stocks are only impacted by what goes on within their borders. It's not the way it works.
Well, okay, the BOJ kept their short end of the curve unchanged last week. And actually, I'm looking at this article on Yahoo Finance about a Bloomberg survey. Economists don't expect, or people watching this don't expect, any further changes from the central bank this year. What's your response to this?
That means I expect policy changes, right? Because I always go back to opportunity always exists when the crowd thinks it knows an unknowable future. If oil were to keep rising like this, it's going to be a real problem for Japan, which imports pretty much all of its oil, okay, in terms of energy consumption. So, look, when you have stability, there's confidence. I've used that line many times before. Overconfidence leads to leverage. Leverage leads to crashes. I'm pretty sure there's overconfidence in terms of the BOJ, in terms of the Federal Reserve, in terms of AI mania, in terms of the pre-election year dynamic, in terms of squiggles. And by the way, all those people could still be right. Okay, maybe I'm wrong, and maybe there's not a credit event this year, and maybe it's like 2017, which was the lowest volatility year in history, which only happened, going back to, I think, the second one's like early 1920s, roaring 20s. Okay, maybe I'm wrong, but being contrarian isn't about just saying what's opposite of the crowd. It's trying to identify expected value. Right? The expected value, betting on a pot, which few other people are really betting on, probably the kind of bet you want to make. Now, again, I go back to, it's a question mark as to how to play it. Okay, so I am biased. I want to see the flight to safety trade in long duration treasuries, because that's what killed me last year with ATAX, RORO, and JOJO, rules-based. I saw the hell coming last year. I couldn't do anything about it, as volatility was slightly elevated last year, but treasuries didn't really run. If you have a credit event in Japan, the real tell will be how treasuries behave. I mean, if you really want to get a sense of what could be happening, you keep one ticker on your screen, that's TLT.
Okay. Can we just start from the beginning to the end? For the layman watching this, what exactly is going to happen? What is a domino effect? So why is Japan going to get inflation if the BOJ does nothing? What are they going to do exactly to intervene? What's going to happen to the yen as a result? What's going to happen to U.S. markets as a result?
It goes back to the mothra, not the butterfly. So if inflation were to keep on rising because oil denominated in yen keeps rising, if the yen keeps falling, they're going to have to step in to defend it. If they step in to defend it, that unwinds a lot of short covering in the yen, unwinds the carry trade, which conceivably means that people then have to sell off their investments in all risk-on assets, in particular, by the way, tech, again, given that correlation of the dollar yen to technology. And that then sparks conceivably a global margin call. Now, by the way, we are in August, September, October. Historically, anyway, seasonality-wise, that's when the VIX tends to spike. This is not my opinion. This is pure data, pure fact. So all this is happening anyway at a time when likely volatility is going to rise. And by the way, just as everybody's screaming, new bull market.
Why is there a big short position on the yen right now? You said they're going to cover their shorts if this happens.
Yeah, it'd be effectively like a short squeeze. No different than like what I expect in treasuries. You look at speculative short positioning in treasuries, you see a similar dynamic, right? It's basically kind of it's a mechanical type of dynamic rather than one based on a bet.
I understand. Okay, so Japanese equities, is that going to be impacted first?
Interesting question, probably, especially because everyone got so hyped around Buffett and Japan's markets being close to the all-time high. But again, it's like, I don't know if it's a question of what's first and what's not. If it happens a little very quickly. The last year really, I think, screwed with people's mindset in terms of how markets work. They think that markets decline slowly, okay, and that there's time to take advantage of a declining market, because last year was like a controlled implosion in all risk on assets. That's not the way markets historically work. Markets historically work in terms of staircase up, elevator down. So whether it's first or last, the time with which, if an event happens, it permeates throughout the globe, it will likely all happen roughly at the same time, right? Now, by the way, I keep going back to, I don't know if it plays out like 1987, but anybody that thinks that this can't happen is blind to history. I keep going back to 1987. The Dow was up like 38% prior to the crash of 87. And 1987 was a pre-election year, and the Fed pivoted. So we know that it's not impossible to see massive moves, and still, by the way, an up year, because in 1987 the market was still up, right? But the point is, like, it almost has to come from out of left field, right? It has to be something that's not obvious.
Let's dig a little bit deeper into your thesis and examine each individual component. So on the inflation leading to the Japanese yen falling front, okay, I understand in theory how that works, but keep in mind all throughout 2022, the U.S. experienced high inflation and the DXY continued rising. Again, that's because of monetary policy. Why can't the same thing happen to Japan?
Japan's got 263% debt to GDP. I mean, it's ultimately about how much bonds they own. I mean, it's almost like the bond vigilantes. If they're going to target anything, it's Japan, which everyone just forgot about. But it's like they are the biggest holder of their own bonds and everything else. So, the dollar, you're right. That was one of the most fascinating parts of last year, right? The dollar was ironically the best inflation hedge, right? But that's because of the reserve currency status, you can argue. And the dollar is a risk-off play, just like the yen tends to be a risk-off play. So the yen would rise. That's my point. If the yen keeps going down, they're going to have to step in to cause a spike higher in the yen. It's that catalyst of causing the spike higher in the yen, which sparks the short covering, which sparks the reversal of the carry trade. My argument is that they have to do that. If oil were to keep rising and the yen does not stabilize, they're going to have to act because it's too much of a problem for the society, to your point, with a country and its citizens that don't know what actual inflation for a prolonged period of time, let alone hyperinflation or a scenario like that, could possibly feel like.
And by act, do you mean specifically raise the central bank policy rate? Okay.
Right. Or pretty much you get even more aggressive on loosening the yield curve control. They're going to be pushed by the bond vigilantes. We've seen this before with Japan. This is not new.
Yeah. Going back to inflation, okay, this is important because the Japanese have this culture of saving. You know what happened with the 90s? People are still living in the past. They don't want a repeat of the 90s. And so I think the inflation rate right now is somewhere around 3%, right? I think the Japanese inflation rate is somewhere around 3%. That's why the central bank didn't do anything last week. Do they want to risk deflation if they raise rates?
It's an impossible choice. It really is an impossible choice because you risk deflation. Okay, well, good luck with bonds. You risk inflation. Good luck with your citizens. It's an impossible choice. All the fears around Japan may end up being true that people have been arguing for decades. It's just, nobody cares about it until it matters. And when it matters, it's the only thing that matters. So I don't know. It's a hard decision to try to think through what the after effects would be. But again, I go back to inflation is good if wage inflation is higher than costs of goods and services in terms of the pace with which it's moving. If you have significant cost push inflation because of oil prices dominating the yen, that's a real problem.
Let's say that they do raise rates and your thesis plays out correctly. What does that mean for the dollar? Presumably, the dollar would go down because the yen is a big component of the DXY.
Well, but not as big as the euro, as you know, right? So I guess it's a question of which pair. So you'd probably see the yen rise, against the dollar, right? So that relationship flips, which again undoes the carry trade. But then the dollar against the euro probably rises against other currencies because then it's a global flight to safety type of trade. So I suspect it's probably going to be both, but it's a question of which pair you're looking at.
And does this have any direct impact on the U.S. economy overall?
It could if. So this is where it goes back to the housing dynamic I mentioned earlier, how I was wrong. There is, I think, a legitimate argument to be made that the reason you're seeing a little bit of a reacceleration in housing is because of what the stock market has done this year. It's animal spirits, right? It's wealth effect from the stock market permeating into home demand, still increasing relative to still tight supply, independent of mortgage rates being as elevated as they are. So let's play that out. If that's the case, the stock market breaks pretty hard conceivably. Credit spreads widen. Suddenly now it might impact on the ground the U.S. economy because if the housing market was being bolstered by stock market prices going up, it stands to reason that the reverse is also true.
Yeah, this is what we like about you. If your thesis doesn't play out once or twice, at least you admit it. On the housing front, yeah, it hasn't crashed yet. I mean, maybe time will tell. Maybe you will turn out to be correct. But yes, you're right. So far, we haven't seen a big crash. And in fact, overall, I mean, in fact, the Case-Shiller index has just recently started rising again. The Japanese carry trade, so let's suppose that whole narrative implodes. does that impact Fed policy at all? I understand that monetary policies are independent of each other, but they've still got to pay attention to, impacts.
Yeah, no. So this is actually a really interesting thing to think through as a thought experiment. Because to your point, the Fed doesn't step in until you get credit spreads really blow out. The Fed doesn't care about the S&P; they care about credit spreads, right? People, I think, mistake the Fed put as something based on stock market levels, right? What they care about is credit spreads. Usually, when you have declining stock prices, the VIX spikes, credit spreads blow out, and that's why the Fed steps in, because of default risk repricing happening. So I suspect they probably would, but the question is when, because I find it hard to believe that the Fed would allow itself the potential to be whipsawed, meaning you get some kind of Japan catalyst, global markets go into a tailspin, and then what? They're going to step in right away after Powell literally just said we don't foresee a recession, and they're going to liquefy against inflation, which is still elevated. I think it's a very tricky spot because the optics of that would look horrible for Powell.
I'm just curious, your whole thesis about Japan, could that play out from Europe as well? The ECB raised rates last week for the 9th consecutive time, I believe, is now back to the highs. So could it, in theory, not work from the ECB side, or no?
It could, but it's more about the amount of leverage that the yen carry trade has on the global system, right? Japan is unique in that sense relative to every other country and zone of the world.
Final thoughts on Japan before we close off and talk about something else? So any other risks from that region that we should be aware of?
No, what I would say is I think you just said the term correctly, risks we should be aware of. There are always risks, right? And the point is that nobody knows what tomorrow brings, including me, right? So I could be totally wrong, and everybody else could be totally right. The Swiggle boys could be unequivocally right. Maybe NVIDIA is going to go to 1,000. But you have to do scenario analysis, right? If this happens, what is likely the outcome for my portfolio, right? And all that means is that you have to be aware that risk still exists. That's what is mind-numbing to me about the greed and fear index, the put-call ratio, margin debt relative to free cash flow. It's like suddenly we're at a point, active manager equity exposure being at the highest since November 2021. It really is true. Everyone's on the same side of the boat now. So, they could be right, but I sure as hell don't want that boat to tilt over.
Scrolling through your Twitter, I think you were trying to highlight the importance of the yen carry trade. You highlighted a paragraph from an IMF article, and the abstract reads, the financial press at the time, I think you were talking about the 2009-2008 credit crisis, referred to a collective margin call on the United States in which foreign creditors sought to reduce their exposure to the deteriorating creditworthiness of U.S. borrowers. This paper argues that the carry trade should instead be viewed in the broader context of global credit conditions. What does all this mean?
It means we're all. I don't know how else to say it. It's like no, but really, it's. I'm making light of it because I think it's funny, legitimately, and I think you have to have humor in the face of what could be a crisis that nobody can really fully control, just try to manage through, right? But this is the point. It's like it's more than just the Fed. Liquidity is more than just what the Fed says and does. It always is. So that IMF paper is interesting because it would suggest that the yen carry trade was actually a bit of a catalyst also when it came to the subprime crisis, right? Again, butterfly flapping its wings, Mothra in the case of Japan. And I mean, I get it. Godzilla ultimately won, but he got his ass kicked for a bit.
Okay, let's talk about U.S. markets. You were on the show with me, once in May, but I spoke with you, I think, in March as well. You were predicting a melt up by the end of the year. Markets are kind of still, I don't know if you want to call this a melt up, but it's still rolling ahead. Melt up is are you expecting a more dramatic rally? Is that I'm just trying to, I'm confused because you sound bullish, but you are bearish.
I wouldn't mind. Well, no, because path matters more than prediction, right? Like,
sure.
1987 was still an up year, was still a bull year, but you had crashed it, right? That's my point. It's about the sequence, not the end point. Okay, so I think that if a credit event happens, afterwards, there's a really, really good opportunity in emerging markets. Now, I put that tweet out in June saying I think there's 3 fat pitch trades coming. A melt up, surge in small caps to play catch up against large caps. That didn't really happen on a relative basis, but small caps and breadth did widen out. Then a credit event, then emerging markets run. Okay, now, why is that? Because if you have a credit event, you're going to have liquidity like crazy coming back in. It's just a question of when, right? And my argument here, or my bet, I think in thinking about the sequence would be that emerging markets have been dead money for well over a decade, which, by the way, was also the hell for me with my mutual fund because it plays emerging markets on the risk on side, which has been death by 1,000 cuts since 2012. I think there's maybe some potential there for that to be the case. I've made that argument before. This whole AI mania, okay, because to your point, it's kind of a melt up. It's not a full melt up because it's really just selective in a select number of stocks. This AI mania, I think we're going to look back and say with hindsight, that marked the blow off stage of large cap US dominance on the global scale. And if I'm right on that, there's going to be a hell of an opportunity to go back into value. Because think about it, if you have a credit event, the first thing that people do is they don't sell their losers. They sell their winners. It's called the disposition effect, right? From a behavioral finance perspective, when you have to deal with losses and you're afraid of something, and if you have losing positions in a portfolio, you're not going to sell your losing positions because you want to get back to break even relative to the price you paid. What are you going to sell? You're going to sell the things which are up the most, which means the entire AI mania suddenly turns into AI busts because of behavioral factors, not because of narratives, but because of people acting on emotion.
So this emotion is going to reach an inflection point at some point.
Right. And my argument would be that and if I'm right on that, my argument would be that that's a longer term rotation finally back into the value style. So I know I'm throwing a lot of interesting, or maybe not interesting, but different concepts, but to me, it's all very interconnected.
Okay. All right, I'll give you two stats. So global credit impulse has been declining. The growth of available credit in U.S. commercial banks is now in negative territory, which doesn't usually happen. It's happened a couple times only in the last 50 years. This credit event, is it going to make these two things worse or no impact at all?
Yeah, potentially, although you could argue it ends up being the same response we saw after March, which is that it created an increase in the money supply, right? It became the excuse to do something, to reliquify, stealth QE, right? I mean, I have put out, I think last time I was on your show, where I said, I referenced that tweet where I said, the regional bank, in quotes, crisis was manufactured. And I say manufactured, tongue in cheek, but manufactured in the sense that it gave them an excuse to stimulate in a pre-election year when you already have high inflation in a backdoor way. So I suspect that playbook comes back. But again, you have to refresh the fear first.
Why is bank credit declining? It's easy to attribute this to the regional bank crisis. We've had four big fallouts, according to the FDIC, since the beginning of the year. But actually, it's peaked. I'm looking at the growth of bank credit for all commercial banks in the U.S. I'll put a chart on the screen for the video. It's peaked last summer in August. It's exactly a year ago. It's been declining for a year, well before any of the banks started collapsing. What happened?
But that's the effect of the yield curve. Right? I mean, the effect of an inverted yield curve is you basically squash lending. There's no net interest profit margin, right? So that's what I'm saying. It's like people only care about the stuff when the stock market goes down. Nothing's changed, right? And again, there are lags. Somebody once tweeted at me saying, in my thesis that we're still in a bear market, which again, I could be totally wrong on. And again, you can't do anything with it. It's more about perspective. Somebody said to me, well, you never had a bear market rally last 9 months. You never had a yield curve this inverted. You never had an interest rate hiking cycle this fast. Nobody has any damn clue what this all means.
It's just incredible because if you overlay the S&P 500 with bank credit growth over a medium-term horizon, I'm not talking about gyrations in the short-term basis, but over a medium-term horizon, there's a good correlation there. And that's perfect. It's a good correlation there. Completely fallen apart, this correlation, over the last year.
It's not a productivity system. It's a credit-based system. This is what people really don't understand, that point. It's really all about credit. And credit is vulnerable to shocks. And sometimes the shocks happen domestically, and sometimes they happen internationally, right? And that's all I'm trying to emphasize. I'm trying to get people, I'll tell you what, even if I'm wrong on this, if I've accomplished anything in how loudly I've been on this, I've at least maybe got some people to be aware of Japan and the carry trade, right? Which is a big deal.
Absolutely. I think you've educated us, which in itself has value. So let's assume you're right. Let's assume you're right until proven wrong. This is the way our system works.
Right.
What do we do about this information with our money?
Yeah, and this goes back to, this is why I myself am conflicted on this. Right now, I'm biased. Right, I go back to one of my arguments for the bear market still being in place, it goes back to the interaction of treasuries to equities last year. First time in a top 20 drawdown in history that equities lost less in a major drawdown than treasuries, long duration, TLT as the proxy, right? And that the bear market ends when it turns out it looks more like 1968, 1970, where both suck, but treasuries still look better. Okay, now I believe that if you have a credit event, you're going to have a flight to safety trade in treasuries. Now, some people will say that seems inconsistent because if you're going to have the BOJ stepping in to save the yen, they're going to sell treasuries to do so. Well, the problem is markets have funny ways of acting different to the narrative. In 2011, S&P downgraded U.S. credit quality. In 2011, everyone thought when S&P did that, it meant yields would spike on treasuries, that you'd have rising rates on the long end. It was the exact opposite. Despite the credit quality of the United States government getting questioned in 2011, yields actually fell in August of 2011. TLT was up like 20%. The S&P was down 17 in like 3 weeks. Even though you think it doesn't make sense, they actually made us aware that default risk was higher for the U.S. government, yet yields fell. So I do wonder if that becomes more the play. Now, I do think also that the dollar probably runs, utilities probably outperform, also due for relative strength. Gold, I think, gets to be really interesting here because you're still around the prior peaks that it just can't seem to break through. If you have a credit event, and I'm right that you still have a bear market, or that you're still in a bear market, I suspect institutional investors will at the margin rebalance to gold. And that might cause some interesting self-fulfilling momentum if gold then does break the prior highs. So I think, just like you're saying on Twitter, it's like watch gold. It's more than just treasuries. I think gold actually becomes really interesting here sequencing-wise.
Yeah, I like how your tweets are sometimes very detailed, but sometimes also very cryptic. Watch gold. Where's the gold? Are you telling us to go on a pirate hunt? Like what?
When I say watch gold, I'm talking about watch David Lynn's YouTube channel.
That's funny. Final question. All right. Do you think the yield curve is going to uninvert over the next 12 months?
Probably. And if it does, that's typically when a recession then is actually
exactly, yeah.
Right. So, which again, it's like all this makes sense, right? It's all connected in this way. And again, people only care about it when it starts to actually impact their wallets. So, yeah, I think that seems to be very plausible. But also, you never know. It's like we've already seen really weird, anomalous behavior compared to history. So the real conclusion to this video is nobody has a freaking clue what tomorrow brings, but you have to entertain the possibility that the crowd is going to be wrong. And the crowd, yes, is right on average, but it's very wrong at the extremes. And I'm telling everybody that's watching this and listening to this, it is not my opinion. The fact of the matter is, you look at the data, everyone's on the same bullish side and nobody is prepared.
Listen, a lot of bears this year stayed on the sidelines, and the criticism here is that, well, you stay on the sidelines, you missed the rally. Maybe you didn't lose money because you weren't shorting, or maybe, I don't know, some people have, but let's suppose you were just on the sidelines. You didn't lose money, but you also missed out on the gains. People were upset at that. How do you respond to such criticism?
First of all, again, I'm going to go back to path management more than prediction. You can be both bullish and bearish at the same time, depending on time frame, right? It's like I said, melt up. I was one of the loudest guys in October saying that. And I said it for the year. I said many times, a melt up year with this credit out there. So people come to me and say, oh, you've been short. Show me your puts. First of all, my Roro ETF is like up 25%. Risk on, risk off. After getting, unfortunately, destroyed last year because treasuries failed, right? And I haven't had the flight to safety trade, which is where hopefully that fund really kicks in. ATAX is down. The mutual fund, you got whipsawed around regional banks. JoJo, my bond fund's actually done fairly well. But again, it stands out when you have a credit event. So in my world, the risk off side is not a directional bet. It's a bet on treasuries as the counter. Now, again, that's what failed last year. But the argument that I'm a perma bear, which is beyond hilarious because I scream melt up repeatedly. The argument that you should be shorting is nonsense. You can have a thesis, but knowing the when is what matters, right? And it's like, I wish people would think more in terms of if you're negative on things, it doesn't mean short NVIDIA. It means look for an imperfect hedge to the broader stock market. Imperfect hedge meaning something that can do well in high volatility, but in the event that you're wrong on your timing, still gives you a chance at compounding. Shorting does not allow you that. Puts do not allow you that. Treasuries, utilities, gold, the dollar, they do allow you that. That, I think, those four horsemen of the risk-off opportunity set, that ends up being the real way to play it when you're negative, not by saying, I'm going to make a bet that something's going to go down.
I think I'll have you on next time, and we'll do a session on hedging. I think that'll be a very interesting
Very
discussion.
important.
That'll
Very,
be
very important.
that'll be another 20-minute discussion about hedging strategies, your philosophy, because everyone's got a different philosophy. But yeah, that's very important. Let's end off here, Michael. Thank you very much. I want to read your research. Where do we do that?
So leadlagreport.com, also on Substack, leadlagreport.substack.com. By the way, folks, I do that research separate from my funds. I'm somebody with skin in the game that not just is putting a lot of content, but also is an entrepreneur managing assets. And as much as I've had a hard time because the opportunity set, the cycle has only favored large caps, which is the worst thing in the world for somebody rotating risk on outside of large caps, worst environment in the world, pure risk on when you don't have any kind of risk off sequences. I at least am out there putting stuff which you can agree or disagree, but hopefully at least provides different perspective and hopefully gives people a chance to respectfully debate, which I think is missed in today's society.
Just on a personal note, how do you find time to write stuff while also managing several ETFs? I mean, I'm doing.
You don't see the bags under my eyes. Look at me. I'm exhausted nonstop. I'm always up.
Like, how do you manage that time? Like, do you have researchers working for you? Like, or do you have, like, you just like don't sleep or like?
All of the above. Listen, I'm running a company with Lead Lag Publishing LLC. That's the research, which again is separate from the funds, right? But it's all me, right? So it's like all me in terms of the intellectual property, the thoughts, all this stuff. So I do my best to just be different and in a way that's thoughtful, hopefully with integrity. And I do my best to give props to you because, again, more people need to listen to what you have to say. I always get back to that. I forget the exact Voltaire quote, but it's something along the lines of, the true test of intelligence isn't the answer, it's the question. So you, my friend, are extraordinarily smart.
I appreciate that. Good compliment coming from you. And, it's not my opinion that matters. I just asked the question. So thank you for giving us your opinion today on both your live stream and also on the YouTube channel. So appreciate it. Thank you very much, Michael. Have a great day. We'll speak to you next time. Thank you.
You understand this, my friend.
Few. Follow Michael's Twitter. Few.
Exquisite.
Well, actually, I wouldn't even say few. A lot of people follow your Twitter. But add to that 740,000 subscribers count. I'm David Lin. Thank you for watching. Don't forget to subscribe.